What does Donald Trump have to deliver to that core audience, his core voters, to say, you've got more money in your paycheck, you, the blue-collar worker, have more money in your paycheck, I've made your life better?
I think what he needs to do is exemplify with programs and proper actions that the type of things necessary, policies necessary for there to be growth to actually happen. He needs to go into a little bit more detail on some of the things he's going to do. We've talked about lower taxes and tax reform. We spoke about deregulation. I think getting into some of the details will probably help.
So when he gives that address to the joint sessions of Congress tomorrow night, what are you going to be looking for in terms of that detail? What do you want to hear from him?
Well, I want to really hear some of the specifics, and especially one of the few negatives of what he's been talking about is this whole notion of some sort of trade restrictions and import taxes. And I'm a believer that the free movement of goods, capital, and services is good for the global economy, is good for the U.S. economy. And hopefully he will acknowledge some of this and maybe back off some of that trade rhetoric. On the other hand, he should hit the accelerator on some of the deregulation and tax reform, because clearly our tax system is a mess. The corporate tax rate is the highest in the developed world. And what we really need are policies that enable business people and risk takers to go for it. And this is what we've lacked for the last 8 years. It's been a sin to make money over the last 8 years, and we need to say no. Making money and growing and employing people and investing, these are all good things.
So, David, how much do you want to hear about Obamacare? And for this specific reason, are you concerned that repeal, replace could get in the way of some of the things you're talking about, like tax reform?
And they're definitely related. If you hear the noise from Washington, they are related. So, and I think they have to work hand in hand. Everyone is saying, well, where's the plan? Where's the plan? Well, you know what? If they're carefully looking at this and analyzing the impacts, they should be taking their time. There's no need to rush. You do need to make progress. You do need to make the ball forward, but there's no reason to throw a bomb right now.
David, some of the optimism around the situation with the White House, the Trump administration, has been priced into financials here in the United States in a big way. The steeper yield curve, the prospect of regulation being cut. Your biggest position, though, one of them, is in Credit Suisse. And I just wonder how you offset the optimism in US financials with some of the pessimism that still exists in European financials, and why you're there in a significant way.
Yeah, I think the pessimism in European financials is unfounded. It's unfounded. The valuations are too low. Things are starting to turn in Europe from an economic growth perspective. We're seeing a pickup in lending growth. The financial businesses in which we're invested, Credit Suisse you mentioned, BNP, and Intesa Sanpaolo, Lloyd's, all have really had a good rein on costs. Fee income's ticking up, and they're all selling at near single-digit price-to-book and price-to-earnings ratios with decent dividends. So I think the European financial sector is really one of the more undervalued sectors globally when you look today. And even in the U.S., you could find certain financials that haven't had quite a run. I mean, look at Citigroup in particular. So there is still room in financials, and I think European financials in particular. The fundamentals are there, earnings are going up, and valuations are low, and that's, for a value investor, this is what we look for.
David, I know that's what you look for, but I just wonder whether your management, the faith you have in it, was shaken somewhat when you hear reports like Intesa looking to link up with Generali. What were your thoughts on that when it broke just a couple of months ago?
Well, we trust that they will really, if they are looking at making a big acquisition, and big acquisitions are not easy. You have to look at the price you're paying, and you have to integrate, and all the distractions that come with it. So we were just hoping that management would carefully look at it. And yes, if it was a huge deal to be made in terms of the ability to create more shareholder value, maybe they should have done it. But if in fact that the difficulties and the risks are too high, they should back away. And to me, this is a positive indication that management took a look at it and realized that this was not right for them, that certainly that the cost exceeded the benefits, and they backed away from the deal. So ultimately, that was a good sign of what management did. They did their job, they looked at it, and they objectively determined that this was not the deal for them.
David, you're the 12th largest holder of Citigroup, and that stock, along with other U.S. banks, has had a huge run since the election. Citigroup up 23%. How much of that is based on regulatory reform out of the Trump administration?
Well, I think some of it definitely is, because the regulatory issues had been headwinds in the financial sector. But I think in Citigroup, you also have a slow evolutionary improvement and restructuring of the business, refocusing of the business. So you still have very depressed valuations for Citigroup, and you have what should be an improving U.S. economy, better for lending growth, better in terms of lower loan losses, and you have a better regulatory environment. And then with the higher interest rates, you have the yield curve. So there's still a lot of good things in the future for Citigroup.
So, David, does that mean that you're adding to your position for Citigroup right now?
Well, we really never talk about what we're doing currently, but it's still a stock that we view as attractively priced.
Citi has made a lot of progress, as you say, David. At the same time, of all the U.S. major banks, it's probably the most exposed in terms of cross-border transactions. A lot of its core business is representing clients as they cross borders. Are you concerned that there may be some difficulties in store for them because of trade?
Well, again, anything that inhibits the free movement of people, of capital, of goods and services is not a good thing. And you're right, Citigroup does have, we'll call it an international kind of flavor franchise to it. So yes, this is something to watch, and perhaps this is a reason why it still trades at a fairly healthy discount to some of those financials that have actually run a lot faster and stronger than Citigroup.
All right, let's talk about one of your other great calls, and that was Glencore. You're the 4th largest shareholder there, and that has had a killer run. That stock up 150% in a year. I feel like last year we were talking about if they were going to be able to actually pay off all their debts. You're not going to tell me if you're buying or selling, but can you tell me if it's properly valued?
Now, again, this is still one of our top 2 or 3 positions. Despite that run, it just goes to show you how oversold the stock was. I mean, this is a very good company that unfortunately made a mistake a couple of years ago, a little too much leverage going into the low end of the commodity cycle. Now remember, 30 to 40% of their EBIT is in a trading business, which is almost annuity-like with a decent growth stream, a decent growth rate, by the way. And their 4 or 5 main commodities have bounced, and their largest hasn't bounced all that much. Their largest commodity that they mine is copper. Now that's up, but it's not up anywhere near as iron ore or coal or some of these other things. And so this is what we're still excited about, is copper is still below what we think is a normal price. And meanwhile, their top 2 or 3 others, zinc and coal, you know, they're in good cost positions in the cost curve. You know, demand is holding up, especially for coal, despite all the green fears.
Yeah.
And so we still think this company is selling at a significant discount to its intrinsic value, and this is why it's still a relatively large position in our funds.
David, Ivan Glassenberg, the CEO of the company, someone you've stood by and supported over the last couple of years when the company went through some really difficult times, has spoken recently about the potential for a big dividend this year. As someone with a very long-term time horizon, as an investor like yourself, is Glencore ready to deliver a big dividend in 2017, or is that too soon?
If commodity prices continue where they are today, they're going to generate lots and lots of free cash. With their leverage levels almost exactly where they should be able to give more back to the shareholders in terms of a dividend or whatever way is most appropriate. So I think if you look at where cash flow is, where debt is, they've done a great job. This has been a textbook turnaround. It was one of the things that was puzzling to me is in 2015 in September when they announced the balance sheet repair, the market didn't seem to believe it. And in early 2016, January and February, there was a huge buying opportunity. And we were already 3 or 4 months beyond the balance sheet restructuring program, and the stock was still heading down when we thought it should be going up. So there's a deal of trust that we have in the management. Ivan is the biggest shareholder of the company, so there's a very good alignment between management and shareholders. So we would concur with his thoughts on the dividend.
David, just quickly, you talked about Glencore and a textbook type turnaround. As an investor, it's an incredible opportunity to gain some significant upside. Do you see a Glencore type opportunity that exists today? And if so, where?
I think there's a lot less dispersion in valuations as we saw, say, post-Brexit or in February of 2016, where you saw a huge gap in valuations between, say, industrials, consumer discretionary and financials, and, say, the safety stocks, staples, utilities, telecoms, healthcare, et cetera. That gap is closed a little bit, but I still think European financials is probably the area around the globe that is yet to be properly revalued. And you mentioned Credit Suisse. This is still probably 60–70% off where it was a year and a half ago. And they've done a lot to repair themselves. They've done a lot of work to make themselves a better company. So companies like Credit Suisse and some of the key European banks like a BNP, like a Lloyd's, like an Intesa, and even some of the insurance companies like Allianz, where you see they have so much excess capital, they've announced the big stock buyback. They're still selling at really low valuation multiples. All, I would say, part of this whole Europhobia, with the last year with the UK referendum and this year with the French and German elections. People get so obsessed with these elections, they just lose focus on companies' ability to generate cash, no matter what the outcome of these elections are.
Do you wind up, though, protecting yourself, though? Because the French election is a risk, right? So do you hedge these bets in any way? Is there a trigger that you winds up reversing your view?
Now, what we do is we just really try to measure how the impact of a French election would have on our company's cash flow streams. Now, note, a lot of the companies based in France, most of their business is outside of France. Even BNP has huge businesses in Italy and Benelux, and they even have, Bank of the West in the United States. Perhaps what a lot of this instability does cause is pressure on the euro, which again is actually, though you take that hit up front, if you're holding European stocks and the euro drops, you take a currency hit. But on the other hand, those multinational companies get an earnings enhancement from their foreign-based earnings if they have a weak local currency like the euro. So this is one of the ways that this political instability and volatility manifests itself, is in a weak euro. So we do watch these things. If currencies are way overvalued as determined by PPP, we tend to hedge, but generally speaking, we're bottom-up, long-term value investors. We try to identify good companies that for some reason are out of favor, and that reason is often these political events. So we try to take advantage of what these markets give us in terms of low valuations and wait through the cycle. Sometimes you have to sweat a little bit, but if you're disciplined, you'll make lots of money for your shareholders.